Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Ron, thanks for taking some time to join me on the show.
Thanks, Owen. Thanks for having me.
It's good to be recording in person in Sydney. It's the first time we've met. Although I've seen you on Twitter, seen you elsewhere. It's great. There's so much for us to talk about. We'll talk about investment process, your story, companies, all the works. I think we have like that. Misery does love company. At least for me, it's misery on my side with EML, not so much on your side.
That's plenty of misery.
Yeah. But before we get to that stuff, can you take us back a little bit? Before funds management, you seem to have had a different life. Can you tell us what that was and how that led you to investing?
Yeah, sure. Probably my sort of path to funds management is quite unique and untraditional in the sense, I finished an industrial engineering degree at uni, so I didn't really study any finance degree. And then after that, I never actually went and worked in the corporate world. I was quite entrepreneurial. So I just started different businesses. I was involved in a marketing agency business. We helped small businesses sort of improve the digital branding and sales. Then had a retail business in the fashion industry. Then I launched health insurance for cats and dogs, pet insurance, together with RSPCA. Did that for several years and had a few other different businesses. And at the same time, I was always quite passionate and interested in just generally how businesses work, how they make money. And I was always fascinated by entrepreneurs, people that, set up successful businesses. And, I admire those kind of people. So I sort of self-taught myself through, reading a few books, but I'm not a massive sort of investment book fan. And sort of, I guess, had a knack for understanding what's a good business, what's not a great business. And the money that I was making from these businesses that I was running over time, I started investing. Mm-hmm. I did relatively well. And then I decided that, investing really is just one of my passions in life. I just love doing it. It's not work for me. It's like the old saying of Warren Buffett, sort of tap dancing to work kind of thing. Well, for me, it's just, I do it at night, I do it on the weekends, I do it when I'm traveling. So I started doing that. And then I decided that, I said, well, if I'm good, I might as well set up a track record. And this was back sort of 13 years ago, back in 2010. And back then, you can see my age, but, there wasn't a lot of finance and social media world wasn't as big as it is today, like the TikToks of the world and the Twitters. So there wasn't a lot of sort of content sharing and stock sharing ideas. So I launched a Facebook page called The Boat Fund. And I basically started sharing my stock picking ideas, but it was really about also interacting with other investors. And back at the time, there weren't many social media sort of share investing content pages. So it became quite popular. We had sort of, I think, 7,000 or 10,000 sort of, followers, and it was a good interaction. Ran that for a year. It was really successful. And then on the back of that, I got approached by someone in the industry. And he really liked my investing style, which is more sort of small cap oriented. And he wanted to launch a fund with me. And then I teamed up with him and another friend. And we launched the Boat Fund, the real Boat Fund.
Why did you call it the Boat Fund?
Yeah, so we call it the Boat Fund because I heard a really good story about two mates who decided that they wanted to buy a boat, but they didn't have enough money. So they started sort of, trading together, sharing their ideas. And eventually they made enough money, they bought the boat. So really the idea was if we all get together, share our ideas, we can make enough money to buy our dream boat, which was really the theme behind the page. But it was really more about myself establishing a track record somewhere that people can measure it, right? So that was why.
Okay, because it's totally unique, right? Like nothing else.
And in fact, when we launched the fund and we ran that for 4.5 years, sometimes when we used to go to company meetings with management, they used to say, "Oh, the boat people are coming to see you."
So you said that ran for 4.5 years. From what I could tell, the boat fund had a pretty good track record. Why did you close it?
Yeah, well, actually, we all, I think, as you know, in any business, everyone wants to go a different direction. And so we were 3 business partners and we each wanted to do something different. And so we just decided that we're just going to wind it up. And then, I became a private investor for a while. And then I joined, my current role with Tamim Asset Management. I started exactly on the 1st of January 2019, and I've been with them for 4.5 years. And I run 2 funds for them. And it's been pretty good. And so that's kind of like the journey, which is quite, I guess I have to thank Mark Zuckerberg. Right? Yeah.
Yeah, right. So like you kind of got to, a lot of people say that they get to funds management in a very atypical way, but you definitely came to it in an atypical way in that it didn't seem like you were like a career fund manager, one of those people that just aspire to be a fund manager. You got into it because you were genuinely curious about investing and about businesses. Is that fair to say?
Yeah, definitely. Like I said, when I say it's one of my life's passion, it's really, if I sort of see if there's a company out there or something interesting to look into, I will drop everything and look into that. Doesn't matter what time of the day, if it's the weekend or wherever I am, you know what I mean? I love it. It's exciting. And always, finding that next opportunity, not just making money, but also the sense of satisfaction of being the first. And, there is one company that I think I've done really well. And this was back then in the day of 2011 or 12, it was Altium. I mean, now everyone knows Altium. It's a, ASX 100 company. But back at the time, I found it at 50 cents. There was no broker coverage. No one knew about it. You couldn't even contact the management. And it was quite fortunate that the guys that ran Altium were Iranian Baha'i. And that community is quite close-knit. And one of my friends was Iranian Baha'i. And through that, I managed to get access to management. And we realized that this amazing software business that was actually being run by a founder that was, a bit sort of had too many grandiose ideas and wasn't focused on profitability. And by them kicking him out was the catalyst to get the company to profitability and growing it under Aram, which took over and, took it. And I rode that over 5 years from 50 cents to $10. And unfortunately, we sold it then and it went to 40. So there you go.
So okay. So that's a fantastic business, is Altium.
Yep.
Yeah, it's wonderful. And we'll get to. I want to keep picking your brain on some of these companies in a minute. But so for people that are like me, that are on Twitter, you're on Twitter, we're on social media, and we talked off air before about like some AFR articles that have been written or whatever about you. How do you think about like social media, and because we'll talk about EML because that's the misery part of my end, but how do you think about that in your public persona?
Yeah, my funds management journey started on social media, and that was how I really became known and started my career. I guess I've always continued to interact on social media, and interestingly enough, over the years, I don't use Facebook anymore. That whole finance discussion on social media has really switched over to Twitter. I mean, Twitter now is sort of the biggest platform, I think, for financial news. So I think, I like to, the way I view social media is that it's good to have a bit of a laugh. Maybe you can stir a few people up. People get quite sensitive on social media. And sometimes you can get some really good information, some really smart people out there, and especially like a lot of economic sort of news and data and charts. There's some really good people to follow. Not so much maybe stock specific stuff. And there's also a lot of petty hate on Twitter, but I just ignore it. But I guess maybe, with EML, there was an article by the AFR, but
Yeah, I got it right here.
yeah, but with Joe Aston. And look, EML, I guess I'll give the background to EML.
Sure.
So first of all, in terms of our fund, we actually did really well. So we bought EML at around $1.10 when I first joined in early January. And we rode it all the way up. There was a bit of an up and down during COVID, but we rode it all the way up for 3 years, close to $5.50. We took profits along the way and we made a lot of money. And you could see that performance was really good for 3 years. And then in 2022, they started having the issues from the previous year with the Central Bank of Ireland regulator. And everything really went to,
hit the proverbial.
Proverbial. And we like to, so when I look for a business, I really like to back management, especially in the small cap space. You can put anyone to run, the BHP, Rio, the big banks, but the small cap, it's all about the management teams. And what I've learned is also about directors, which EML taught me a lesson. But the moment that, so at the time they had the issues with PFS, the European division with the Central Bank of Ireland, from what came out after is that when the MD, which I was backing all those years, Tom Cregan, he resigned in I think it was June 2022 because the board rejected 2 takeover offers at significant premiums to the current share price. I think $2.25, and there was one before that at $5, and it was all in the AFR reported. And basically, the board of directors had no interest in sort of losing that nice, cozy day job of sitting on the board of a global payments company, regardless of shareholder value. And the MD just couldn't deal with them. He quit. And then when he quit, we sold our shares. And that was in the $20s or 30s, whatever it was at the time. And we went publicly on, Ausbies and whatever. And we said, right now it's not investment grade because, this board is not aligned with shareholders. And then what happened was at the AGM last year, the chairman was ousted, voted out, really close call. And he was really the stumbling block. And then it emerged that an activist fund, Alta Fox from Dallas, spent $20 million to buy shares at around 60 cents. They took a 10% holding of EML. And we have interacted with Alta over the years. And our understanding was that they could see that you could unlock value in EML by, probably divesting the separate business units, which I'll explain. And then at the February results a couple of months ago, we saw the remaining sort of old reign of the board of directors kicked out as well. And Alta came on the board with a couple of other guys that are aligned to them. And they've also announced a strategic review at the moment of the PFS European business, which is the problem child. It's losing a lot of money. And I think that even if they could just sell it for $1, for example, suddenly by taking away the losses from the business, the group becomes much more profitable. There's so much less distraction. And then you can either focus on growing the other business units. And it's essentially, if you think about EML, it's 4 business units. So you've got the problematic PFS business. You've got the global gift and incentive business, which is really the jewel in the crown of this company. It makes probably $25 million EBITDA. There's a lot of fat in there in terms of cost that an existing payments provider can buy it and probably make it $40 million EBITDA business. And that business is very cash generative. And that's probably worth $300 million in a competitive sale process. And then you've got the Aussie reloadable business, which again is very profitable, makes maybe 8-10 mil of EBITDA. It's got good contracts in the salary packaging space, long-term contracts, got some of the gaming cash out programs as well. And that probably fetches, we've seen PushPay get 16 times, probably gets anywhere between 12 to 16 times. And then you've got the Centennial open banking business in Europe, super high growth, break even. Now, when they bought it, they pay 10 times revenue. Multiples have halved since, but their revenue has doubled. So you could argue they could get the same amount of money, which is $100 million. So if you look at their balance sheet, they have $80 million of cash. They've got, $45 million of corporate debt. And then they have two remaining vendor payments to PFS of $20 million each in June next year and June 25. Now, we believe these vendor payments will be contested, and I doubt the vendors of PFS after everything are going to get it. But, put that aside, they don't have like a balance sheet issue. They don't need to raise money. So we believe that you get rid of your PFS, you cut costs. The CEO has to go, Emma Shand. I think she's a disaster. And she's proven, she came in last year after Tom resigned, really because of her regulatory experience. Well, we've seen the announcement from the CBI after the results, and they said nothing has been done for the last 12 months. So what the hell is she doing? So we think she needs to go. They need to cut costs. And I reckon they could sell this entire business for somewhere between $1.20 to $1.50 of net proceeds. And they won't pay any tax because they've lost so much money on Centennial that will offset any gains on the sale of the other divisions. So you're looking at the shares in the 50s at the moment, and potentially you could make 2 to 3 times your money based on this scenario. And we think that Alta Fox does not have the intention to remain on the board of a company for the long term. They're a fund manager. They see it as a special situation, and everything they've done until now tells me that this is what they're planning to do.
So we're recording this just to timestamp, but we're recording this on the 14th of April, 2023. So you mentioned before that you sold your shares.
The fund sold the shares when Tom quit because we, like I said, we like to back management. And when he quit, we just couldn't trust the directors after rejecting the takeovers, yes.
So now do you own shares?
Yeah, so we went publicly. After the AGM, when the chairman was ousted, we started buying back in. And it is a top holding for us at the moment, yeah.
Mm. And okay, that's good. I appreciate the disclosure.
Yeah.
So what would you say then are the risks to your thesis? So I'm always a fan of inverting, right?
Yep. So, there is, I guess the risks is that nothing gets done, well, I guess they could shut down PFS, but if they decide to shut it down, there'll probably be 15-20 mil of redundancy costs. Nobody's going to want to pay up for any of the other businesses. But you could see these businesses get sold on, several businesses like this get sold every year around the world, and like especially the global gift and incentive card business is very valuable. So, I think if you run a proper sales process, it can get done. So the risks is that nothing changes, nothing gets done. It keeps everything the same, and the stock, it becomes one of those zombie companies where sort of goes nowhere because it can't grow earnings and nobody wants to touch it, and But why would a fund manager spend $20 million, go on the board of a company, go to the hassle, all the legal advice and spend and everything of kicking out the board to not do nothing? It doesn't make sense to me.
Mm. Mm. Do you get vocal with the company?
Yeah, I get very vocal.
Other than right here.
Yeah, I get very vocal. You could go to EML website, go to their AGM recording, and you could hear me loud and clear. Yeah, I get very vocal, speaking to them. And since Alta came on board, I've spoken to them many times and expressed what I believe, not only I want, is I believe other EML shareholders want to see, which is what I've expressed today.
Yeah, right. Do you regret not selling all of your stake at the very top?
Yeah, it's a beautiful thing. Look, the reality is that if you look, the initial thesis with EML, which worked for 3 years, right, it worked for many more years than that. The stock started at 20 cents or 10 cents, I think, got to $6 in May 2021. I think the reality is the guys that were running it, Tom and the other guys, they were quite entrepreneurial, really good sales people. And they managed to build a great business, find really innovative use cases. Because in the payments business, if you find new use cases for programs, so for example, the salary packaging stuff, the cash gaming cards, when you have a punt and you win some money, you can instantaneously access it on your virtual card on your phone and spend it. They came up with those ideas, and then they went to the industry companies and they sold them the idea, right? So they created new verticals, right? So they were quite entrepreneurial. I think what went wrong is when they acquired PFS, and PFS was a good business, two things went wrong. One, let's be honest, they got extremely unlucky because of Brexit. In fact, you could probably blame this whole thing on Brexit.
Because it forced them to go into Ireland, right?
It forced them to have another e-money license outside of England because of Brexit. And now, and let's be clear here, the majority of payments companies in Europe operate out of Cyprus and Lithuania, okay? Not the central. In fact, the Central Bank of Ireland does not regulate fintechs. They regulate banks. And since the GFC, that's all they want to do. But the clever people at EML, and that's probably their mistake, they said, well, let's go to the Central Bank of Ireland because it's considered respected. So we're going to be considered like the best regulated fintech in Europe. But guess what? These guys, when they switched over all the programs of PFS over the course of 2021, at the beginning of 2020, over the course of 2020, the beginning of 2021, suddenly the Central Bank of Ireland started seeing significant amounts of money being processed through their money license. It was huge, right? Because PFS was growing, it was turning over billions of dollars. And then they said, what the hell is this? We never heard of this. What are these, all these, withdrawals and cash reloads and all these programs across Europe? We just regulate banks, right? So they freaked out, they audited EML. And since then, it's been 2 years. Guess what? Not a single fraud was found, not a single fine was issued. Where's the breach by EML? Show me, there hasn't been even a fine, nothing, right? They couldn't find anything. The reality is they just didn't want to regulate the programs that EML does, right? If EML went to Cyprus, there wouldn't be an issue and the stock would probably be $5, $6, whatever it is, right? It will continue to grow. And the second mistake was, I think maybe the execution of this acquisition, and maybe they didn't handle it well. Maybe they could have done things better. But as we found out, the directors outside of the management were really kind of, blocking everything. And they weren't really sort of willing to work with management to change jurisdictions. They could have switched. They could have bought a business with another e-money license somewhere else, switched it over. The board wasn't interested. They saw it as a competitive advantage, staying. So I think, that's sort of really the reality. But the business of EML, of just any payments company, is really attractive to us. And it's similar to a software business. I mean, it's you want these really sticky, recurring, transactional revenues where, you can wake up every morning and you know exactly what you're going to earn pretty much for the next 12 months. And it's very hard to switch. I mean, even with all the issues of EML the last 2 years, have they lost any customers yet? No, right? Because it's very difficult. Once you have all these cards out there to your customers, it's embedded within your system, you're processing all this money. It's very hard to switch. It has to be like something has to really bad happen for you to switch, right? So just like a software business. So they're great businesses, which is why they trade on big multiples. And unfortunately, we thought this could be another Altium, you know what I mean? Where we could just back them for many years and this will be just one of those compounders and become like an ASX 100 company and so on, but it didn't work out.
How do you think about like the contagion effect of a regulation? So for example, the Central Bank of Ireland says, we want to check this system, this compliance regime, how you're doing this, how you're doing that. What happens if the Australian regulator sees that, or whoever, insert, sees that and they're like, now we need to take a look?
Definitely. I think just like when you see a run on a bank and everyone loses confidence for no reason, because no one wants to be the last kind of, fancy sort of, so I think the same thing with regulators. I think more so in Europe. So I think that's why the FCA, which is the UK regulator, 6 months ago also decided, what's all this noise for so long? And I'm sure the CBI was talking to them as well. And I guess, so there is a contagion effect and, which is why sort of, especially when you're in the payments business, I think reputation is important. But like I said, again, there hasn't been a single breach or fine that's been issued for 2 years. So where so to me, it just again, it cements the fact that it's more the CBI not wanting to regulate a business like EML rather than EML actually breaching anything serious.
When you say it's a big position in a portfolio, how did you think about positioning? And like, I guess this is like a question more like your philosophy of like, how do you build a portfolio?
Yeah. So, I guess everything is relative. I've heard some fund managers own 60, 80 stocks and they call themselves high conviction. Like everyone has their own interpretation. To me, I think there is a bit of a balance between, diversifying enough stocks across your portfolio to minimize risk, because let's be honest, doesn't matter how much we think we know a company, we actually don't know much except for the people that are running it. And, things can blow up on you, and you don't want to bet your entire, client's money on one particular company. Obviously, so I think to me, somewhere between that 30 to 40 number of stocks in the portfolio is ideal, especially for a funds management business. For personal investors, I think they can probably take on more risk. They don't have anyone to kind of report to. So, maybe 20 stocks. So we usually hold somewhere around 30 to 40 now. Usually, so last year, which was a really tough year, and there was a lot of uncertainties. You had still COVID and lockdowns and supply chain issues and labor issues, and then we had inflation and rising interest rates. There were so many uncertainties and things there were unknowns, and a lot of companies were having issues and downgrades and this and that. We didn't have the conviction to, so we remained a bit more diversified than usual. We own 40 stocks.
Couldn't you get in not your fund though? Can't you go to cash as well?
Yeah, we can go to cash. Look, we always have some cash, but look, I am what I would say, I'm generally a bull. I'm an optimist. I believe that over time, people have a will to prosper and make money. And, yes, I've heard a good saying, it says that, bears may sound smart, but bulls make money over the long term. I've been doing this for 20 years, and, I've seen the bull market of 03, 07. I've seen the GFC, and I've seen everything in between, and all the pigs of the world that were meant to go. And then, we've seen COVID. Now we're seeing this last year's bear market. Bear markets tend to be short. They tend to last maybe 15 months on average. And afterwards, bull markets last for many, many years, right? And, I won't forget, there was a fund manager that went on the AFR front page in April 2020, after the market was down 40%. And he said, I'm 100% cash because the next correction will be the best buying of a lifetime. And then, we all made 100%, right? As the market recovered. So the point is that, look, it's very difficult to time the market. And I think that, if I could, of course, in hindsight, if I knew, I would have gone to 100% cash at the beginning of 2022, right? But no one really knows, right? You don't know how markets will react. And I think we just try and focus on the companies that we own and the fundamentals within each company. And, the market will do its thing in the short term, but over the long term, I think if a company continues to grow earnings, then I think the share price will appreciate. And as long as you can take some of that short-term volatility, over the long term, you'll make good money. Mm. And that's why we don't go to, significant levels of cash. We usually go anywhere between 5 to 20% is sort of where we swing.
Obviously, you run the two funds, the all cap and the small cap income. How do you define your investment philosophy? Like, what are you out there looking to do? What kind of businesses are you looking to find? You mentioned like recurring businesses before with transactional income. You mentioned Altium, which is like a software for engineers and designers to use to design printed circuit boards. Yeah. EML is a payments company, transactional volume. What are the types of models that sit in your sweet spot, and how do you find them in Australia?
Yeah. So, as I said, we're more biased towards small caps. I think this is sort of this is the best opportunity in Australia. I think the top 100 companies, there's not enough under the radar companies, so to speak. And I think, in the small cap space, I would argue there's probably maybe 200 plus investment grade businesses. And at any point in time, there's an opportunity to buy, 50 of those or whatever, right? And a lot of them have really good businesses. The problem with small caps is that they have a good couple of years and then they blow up. And when I say blow up, they don't necessarily go bankrupt, but, management can't execute. They can't take the company into the next level, which was so great about Altium, is they were able to continue growing and taking the company from a small software business to a big one, right? They're able to continue to execute. So sometimes managers or the management team reaches their limit. And so you really have to, you find a business that's going through, its good times, and you try and find it early on. And if it ticks a lot of the boxes that you're looking for, and those are things like, obviously we want a business that's growing. We want a business that's not just growing, but we want to see momentum picking up. So quarter on quarter growth, for example, right? And then we want a business that, profitable. We like profitable businesses. Sometimes we'll take an exception to a business that's growing its top line really, really fast and scaling, and it's just sort of break even-ish. We might sort of, invest in that, but we don't do many of those. And so we look at a business that, profitable, generating good cash. When it generates cash, you want to like dig deep into the cash flow statement, because sometimes companies can manipulate that and they can put a lot of, they can, for example, a software business might report a really good EBITDA number, but then you can see that they're capitalizing all the development cost in the cash flow statement. So actually they're making 20 million EBITDA, but zero free cash because they're also capitalizing $20 million. So you got to look at those things. There's a lot of trickeries that happen in the in the P&Ls and the cash flow statements. And then businesses that, ideally businesses that have good visibility on their revenue, right? So there's a lot of companies out there. We don't really like contracting businesses. So there's a lot of, civil contracting, infrastructure, mining contracting businesses, very profitable businesses. But they're only good for the next 6 to 12 months. And then beyond that, there could be a cliff of, of not being able to fill that revenue hole, for example, right? And, contract-based businesses, a lot of things can go wrong. And we're starting to seeing that now with contractors, with, cost blowouts and so on. And balance sheets are really important. So we're looking for businesses that don't have too much debt. We don't mind some debt as long as the company can manage it really well. Sometimes there are good businesses that are in turnaround modes and they maybe have some debt from the past. But if the core business is good, then under a new management, you could see a path to come out of it, recapitalize the company, and you can actually make a lot of money. We did that in our my previous fund with Vision Eye Institute. It was loaded with debt, but it was a really solid business. Eye doctors, eye surgeons, super profitable, making free cash. Had too much debt. We picked it up. I'm trying to remember, maybe at 10 or 20 cents, and then they recapped, and then it went to $1. Right? So you can find these opportunities, turnaround stories, as long as the core business, the fundamentals are good. So we like businesses that have visibility on what they're going to earn. And then really, you got to look at the management team. Now, like I said, I think if we put myself or you to run BHP, we can't blow it up, right? We might not do a great job, but we're not going to blow it up. It's too big.
Maybe. I don't know much about mining. Yeah, but I get you. Yeah.
Whereas, the guys that are the people that are running small cap businesses, you got to look at their track record, the incentives, how much skin in the game do they have, and what have they done in the past, right? So, I think, after this, for example, a good example would be like, say, Tom Cregan, for example, with EML, right? His next venture, maybe when he comes back to the ASX, that he's the kind of guy you want to back in the early days of a growth company, because great salespeople, entrepreneur, right? But maybe as they get bigger, maybe he's not the right person, right? Because he's shown us some flaws, for example, right? I'm just giving that as a current example. I've been doing this for 20 years. And then the day Australia is quite a small country. You kind of learn, you remember names, you remember what they did over the years, and you quickly see, this company, this guy's on the board, he was a disaster, right? Avoid. Or this guy, he's a gun. He made us a lot of money back then. We're going to back him, right? So I think it's important having longevity in the industry, because people behind these businesses are key to success.
What would your average holding period be? Because you mentioned that there's for a lot of small caps, there's like a 2-3 year window. It seemed like you held Altium for a few years and you held EML for a few years. Yeah,
so let's be clear. When we buy a business, so once it ticks all those boxes I spoke about, then you obviously try and forecast sort of what's going to earn for the next couple of years. You meet with the management, and then you model it, and you try and put a valuation on it, and say, it's worth $1 and it's trading at 50 cents. Well, ideally, if everything goes to plan, and nothing fundamentally changes, you just want to keep holding this and backing it until it reaches your value. And that value it's a continuous, it's fluid, right? It just keeps changing based on fundamentals. Might go up, might go down, right? I recall when we bought Altium back in the day, 50 cents, we couldn't value it more than $1.50, right? But as they continue to execute, the valuation kept going up, right? So there's no reason. Same thing with EML, right? We bought it at $1. They kept executing, growing. It was worth more, right? So we like to back businesses over the long term, as long as the fundamentals don't change and the valuation doesn't get excessive. If the valuation gets excessive, then we either take profits, but maybe maintain a smaller holding, or we completely exit because there's better opportunities. Because like I said, we don't want to own 60 or 80 companies, right? And there's always opportunities, always, just constant opportunities, because a good business suddenly becomes a bad business because of some issues, and then you can buy it cheap, or some company gets sold off for no reason, and it's a great business, so you can buy it. So there's all kinds of, it's very fluid, and that's why we would sell a business. Fundamentals changed, valuation got excessive, or there's better opportunities with better upside.
How do you value, say, a typical company? So not like a turnaround or something like that, but like an Altium in the early days or an EML in the early days?
Yeah, well, actually, see, that's the thing, right? If you look at the Altium at 50 cents, you wouldn't touch it, right? It was first year of making a profit, right? If you look at the previous 5 years, it looked like a disaster, right? Loss making. So that's why sometimes the best opportunities, if you look at their financial history, it looks horrible, right? But generally, if there's a business out there, we like to value it on several methodologies. So the first one is obviously a DCF. So, using a classic DCF model, trying to, forecast what it's going to make, and then discounting back to today. And then also, I think it's important to look at the peers within its industry, the other listed peers, what sort of multiples, whether it's EV to EBITDA or PE multiples they're trading on. And then if the average is maybe 10 times and this business is trading on 5 to 6 times, then you could see that the market, if the business executes, the market will re-rate the valuation and will get a higher multiple. And that's how you make your money.
I think it was Retail Food Group that was in a recent write-up that you did, which is the owner of Gloria Jeans. And it's like an old school franchise, not old school, but it's like a franchise style model. It's been through the ringer over the last 5 years. Like you can look at the share price chart at one point in time, it was probably like one of the worst performers on the ASX.
It's down. I think it's down like 90% over the last 10 years or something.
Yeah. Can you describe like why does that appear in the portfolio today?
Yeah. So this is like a business that we took a position, I think late last year, around 5-6 cents. Look, this is one of those classic turnaround stories where we think that there's a really good underlying core business, which was managed really badly in the previous years by the previous management team. And then for a successful turnaround, like I said, you want an underlying good core business. And we think that, that their franchising and their brands are quite good. I mean, Donut King, they're killing it. It's great, right? Try their hot cinnamon donuts. It's great.
Okay.
after that burger. They've got Gloria Jeans. It's doing quite well, especially the drive-through model. They've got Crust Pizza. I mean, we all know Crust Pizza. It's a great brand. And they've got a few other ones, Baker's Delight maybe, or Brumbies. I can't remember. Yeah, Brumbies. And so it was just badly run by the previous management. They just completely ripped off their franchisees. There's probably a bit of fraud, way too much debt. It was an absolute disaster, right? This was a few years ago. Then a new management came on board. So that's a big tick for a turnaround. You got to have a complete new management team. And the guy that's running it now is really good. Cut costs, recapitalized the entire company, made the banks forgive them a lot of the debt, which is always a good sign. And recapped, a lot of people put in money. I think it was don't quote me on this, 10 plus cents, right? So other people paid for the recap, not us. And we've watched it for the last couple of years. Now they had a few ACCC issues and the class action. That's all been done already in the last few months. That's all been settled. So you no longer have an overhang. They've improved the brands. And more importantly, they've improved the relationship with their franchisees, right? So the franchisees now are happy. They're making money, right? And if the franchisees are making money, I think these are the kind of businesses that are going to do really well in maybe sort of the tougher times. And especially with tourism picking up, because they're located in sort of in all the shopping centers and shopping strips, and the average transaction value is $10, right? So this is not $100 spend kind of business. It's $10 average transaction value. So, and that's why I think you're seeing Gloria Jeans and especially Donut King doing really well at the moment, right? So I think they turned around the businesses, the franchisee relationships, back to profit. I think this year they're going to grow profits by 40% to maybe $28 million of EBITDA. Mm-hmm. They generate cash flow. And now, when we bought it, it was on $100 million, I think, market cap. They had about $25 million of net debt. And a couple of months ago, they basically decided that, the turnaround is complete. And now they're on the growth journey, right? And for them to grow, they needed to spend some money. Apparently, Gloria Jeans is killing it in the US. And they have demand from a few franchisees in Texas, San Antonio, and whatever, to open 100 of these Gloria Jeans drive-through, which could probably make them about 4 to 5 mil of incremental EBITDA to RFG Group as the franchisor. And then they're going to bring a US brand, a joint venture to launch in Australia, something along the lines of like, just like KFC brought, Collins Food brought Taco Bell, for example, something like that, right? Like, I don't know, one of those chicken or burger brands or whatever. I think maybe it will be successful, but for that they need to spend some money to open stores. And then just generally other growth opportunities. I think they can roll out more Donut Kings and more Gloria Jeans drive-thrus in Australia. So now they needed to, so they had some debt with the banks, which was due in September this year. So they had to raise some money. So the, ANZ just wanted out because they took a $40 million hit back in the day. So they said, we don't want this on our books anymore. So they did a capital raise together with one of the largest shareholders, Washington H. Saul Patterson, which is well respected, the Milners. They also lent them a $25 million convertible note over 3 years. So to us, it's like a friendly debt. It's not like a bank debt. The biggest shareholder, they'll be friendly to them. And they raised the money. And I think the stock will now will need to show that they can continue to grow, and they need to show us execution of all these things that I've spoken about. And if they do, you look at sort of your Domino's, your Collins Foods, they're all trading on, 20 times P's, right? This thing is trading on, 9 times. So it ticks all the boxes for a good turnaround, good underlying core business brands, financially good. And they've done everything, and now we're coming in for the growth journey, and we like that.
That's a great thesis, so thank you for going through that. I've got one more just like pie in the sky type question, and I've got a few to close this out. But what's the best business model you've come across on the ASX? But it doesn't have to be something that you own. It could be something that you maybe passed on, or something that you see. Maybe it's a large cap that you don't own. What's the best business model you've come across, and why?
Yep. I'll probably go back to Altium. I just think, not because, I've owned it in the past. It's because, like I said, I think software businesses, if they run well, are probably the best businesses in the world. You build software and then you can sell it, a million times, right? And people pay you, your customers pay you every month or every year. It's very sticky. Everyone gets used to using it, and it's too hard to switch, right? It's like me using the iPhone. If I switch to a Samsung, it's a disaster, right? It's like, yeah. Maybe you're the opposite.
No, I've got enough.
Yeah. So it's the same thing. So I think they're really great sticky businesses, and you can see that well-run software businesses can get to EBITDA margins of close to 50% in many cases, right? So I think that they generate a lot of free cash, high margins, and therefore the market is willing to give them very big multiples, right? Altium trades at 100 times PE maybe, or 50 times PE or whatever. So I think those are the ultimate business models and the companies that we like. And I would argue that Altium has proven over the last 10, 12 years that it's got a consistent track record of delivering and growing, and all the metrics, stack up for probably one of the best businesses on the ASX.
That's fair enough. I'd probably have it in the same regard, to be honest. So I've got just a few really shorter questions. Quick one though. What's the most overrated investing book? You said you don't read that many. What's the most overrated? If someone wanted to learn about the craft of investing.
Yeah. Look, I think there's nothing wrong with reading books. I think everyone, people, there's all kinds of investors that write different books, and they all have different techniques or ways of investing and valuing. My only advice is don't get hung up about one particular method, right? Because it can work in some cases, but then it's actually quite faulty in many other cases. There was one book I remember back in the day that used the return on equity valuation methodology. And again, that can be quite deceiving and cause you to buy businesses that may look cheap, but it's actually not that true. I would say the most overrated, and look, don't get me wrong, I love Warren Buffett and I read his book back in the day. I think probably the Warren Buffett or the Buffettology books are maybe the most overrated. Everyone has to quote him and so on. But the reality is for us Aussie investors, Warren Buffett way of investing, I don't think applies as much because like I've explained, it's a very small country, Australia, not many people. And so in the US, you can find a great business. And for example, if we look at a retail business, right? You can find a business that will go from one store to 6,000 or 10,000 stores over 20 years, right? In Australia, they go from 1 to 100 and they're a mature business, right? Or 200. So I think, the businesses here are more limited by, the growth ceiling. And so, like I said, they might have a few good years and then they reach a problem. Also, generally, and then Australian companies try and go overseas. And so I think that the Buffett way of sort of, holding for the long term and looking for certain things or the certain modes that he looks for, maybe don't apply to many Australian companies. I mean, there are some, but yeah, so maybe that's probably a bit overrated because it's used too much as an example, and I find that there's a joke that like every time like a fund manager, we have a bad month, we all start to think about which Buffett quote to use,
Yeah, it's fair. You should have a drink every time you think about it. Okay, so two more. In your opinion, how does your definition of risk or investing risk differ from what academics would teach? I know you didn't study the academic version of it, but you're obviously aware of it. How do you think about investing risk?
Yeah, I think, and again, because we're more in that sort of small to mid cap part of the market, I think the biggest risk that I've realized to a company is the people that are running it. And it's a difficult risk to quantify, which is why you can't teach it in university or in the books, right? I mean, how do you sort of quantify the risk of a certain individual? I think, the people that are running these businesses are the biggest risk because, like I said, there's some great businesses out there, but they were run by some awful management teams that completely destroyed them. And then when a good management team comes along, they turn it around, suddenly you have a wonderful business, right? So I think that is the key risk that I think is maybe sort of not considered by others or unable to quantify. And it's something that it's like a work in progress. I mean, you can't always avoid it because you might think that these guys, these people that are running this business are good, but then you realize that actually they don't have they're not aligned to you, they have different incentives. They just want to keep their cozy fees or whatever, right? So, it's one of those things. And like I said, longevity in this business and knowing people is probably how you mitigate some of this risk.
Actually, I just thought of a cheeky question to ask you on the fly. In the Aston article, he said, EML Rocket Man. Are we still going to see more rocket emojis?
Yeah, so look, the rocket emoji is only for bull markets. So I'm only going to bring that back when we're in the next bull market.
Okay. But that wasn't my serious question. My serious one is a hard one to answer, I think. I don't have an answer for this. A very good one anyway. What's one thing that you believe about finance, business investing, maybe even life, that few people would agree with you on?
I think... first of all, I think that, what the investing and this world of funds management, investing and so on is quite an emotional roller coaster ride. You go through the good times and everything is great. And then all of us make mistakes. We all lose money at any point in time. And we go through rougher times. And I think, you gotta enjoy what you do. Not take things, too seriously, and try and remember that investing is cycles and things come and go. And, you may have a really bad year or two, but, the cycle will turn and then things will start going good again. And I think if you've got the right businesses, be patient and you'll be rewarded over the long term. That's the way I look at it.
That's good advice, mate. So the two funds that you run, I believe, are wholesale investor only, if I'm not mistaken. And more information can be found on the Tamim website. I've got to say thank you to the ASA for putting this together and bringing our two worlds together. And anyone that's more interested in the Australian Shareholders Association can find a link in the podcast player, and that will take you to get a membership, discounted membership as well. But Ron, thank you for taking a trip across town to come and join me on a rainy day in Sydney. I really appreciate your insights and being so forthcoming.
Thank you, Owen. Thanks for having me.